at what point does this stock market actually come down? It's, you look at what is really driving this. And right now, I think the U.S. market is all about the perception that the Fed will cut rates, which would create more liquidity in the system. I understand that cutting of rates will take 6 to 9 months to get back into the system, which it is also then battling the rate cuts or rate increases prior to that. And so would a rate cut really make a difference? I think it's just a matter of perception that people have that, unemployment's low. Inflation seems to be in control. But I just went to the grocery store and got like 5 items and it cost me $59. And I got a BOGO one, 2 for 1. I mean, it just really isn't. Yet you look at like Germany's indexes are hitting all-time highs. Japan's indexes are at all-time highs. Yet it is obvious their economies are failing. The only economy that's really being represented in the markets is the Chinese markets. Their economy is collapsing and their markets have been collapsing. And they only go up when the Chinese government actually pumps money into their stock markets, and that only lasts 3 or 4 days. So the question I think I have is, at what point does the U.S. markets turn? At what point does the DAX turn and go negative? Because at what point does the reality of the global economies actually start to show up in markets? And it really comes down to liquidity. At what point does liquidity truly dry up? And if you think about like SMCI and its fall out of bed on Friday, NVDA, and those 2 companies in particular, how they went vertical for a month, and what really drives them. And if you really think about it, a lot of this is that whole GameStop kind of situation, where call options are bought, which then, a call option is like a contract, and a contract is just a contract between 2 people or 2 entities. Well, it isn't really money. I mean, it is, but it really, in a way, isn't. And so this perception that they're buying these call contracts on the Magnificent Seven minus, a handful of them like Tesla. Even Tesla has turned around in the last 2 or 3 trading days. But this perception of, that the market is actually good is heavily being driven by contractual money. This is money that there's a contract. When you buy a call, it's a contract between you and the person who wrote the call. And it's a promissory note that if, it hits above its strike price, that you can then buy that stock. Well, it's that mechanic of how do you hedge that? Well, you buy the stock, you buy the index. And in NVIDIA and SMCIs in the Russell 2000, and they've just been inflated by these call contracts, and they're being pushed up. Well, Friday, a lot of them expired. It was a big expiration. So it'll be interesting on Tuesday what comes of all of this. The point of all this is our economies, Germany's economy, Japan's economy, China's economy, and our economy aren't doing so well. China, it's obvious. They're failing. Germany is failing. They are in a recession. Japan is headed in a recession, or is headed to. We, I would argue, are in a recession. The consumer is in a recession. They're delinquent on their credit card debt. They're tight on their money. It's all drying up. But with the hope trade of the Magnificent Seven or Magnificent Four is really in the last year to date has been pushing this. Will this availability of call contracts continue to prop this up until, well, it doesn't. And that's the scary part, is how far could this thing collapse? And as Mark always says, Mark's, runs our swing trading program at Best of US Investors. And by the way, you can get 50% off for 3 months by hitting the link below and using the discount code, just so you can get an idea. That would bring it to $30 a month for 3 months. Then it goes back to $60. But Mark always says, the economy is not the market. And I think it's becoming really, really obvious that this stock market truly, truly is not at all the economy. It's not even representative much of anything. Actually, this market, as we see it today, represents like 1929, where it was a very small concentration of companies that represented the majority of market rises. And what has been the big pusher of markets in the last year? 7 companies. 7 companies. And the concentration of all of this money into those 7 companies has propelled indexes, the S&P, the NASDAQ, even the Dow, higher. But at some point, somebody will disappoint. Tesla disappointed. Look at where their stock has gone year to date. They've turned a corner a little bit. Maybe it'll go higher. Who knows? I doubt it. It's a car company. I know it's a data company, blah, blah, blah. But in the end, they're selling cars, right? And nobody's got money, and it's expensive to finance those cars. So at what point does this give way? I showed a video, I think Kerry showed a video, or a part of our Platinum, Kerry's call on Friday, which you would be a part of if you signed up for the Platinum channel for 50% off for 3 months. I pointed out the volume for the day in NVDA and SMCI in particular, and the amount of call contracts that were transacted on Friday, let alone the whole month prior, is enormous, and that is concentrated into a handful of companies. And so when that goes away, does this market go away? Do we see a haircut? Do we see a 30 to 50% drop? I gotta believe when you pull the floor out from under the S&P and the NASDAQ, yeah, we could see one of the biggest meltdowns ever, all because of the concentration of money in the option contracts on 7 companies. That could be the killer. But in the meantime, you just trade the market you got. You invest in the market you got. You risk manage around it, and you do what is necessary. But at some point, we're going to go, ooh, that hurts.